Morning, Top Gun here, 3:30 a.m. on Friday, April 9th. This is the YouTube pre-market commentary. Okay, section 1, big tech continues to lead market higher. Okay, so yesterday the S&P broke out of the range, the narrow range that had been trading in since Monday morning, defined by 4,068 on the low side and 4,086 on the upside, rising 17 points or 0.42% to close at 4,097. This move was once again led by technology, big tech, with the S&P Tech Sector ETF, the XLK, up 1.44%. The move in big tech has been so powerful of late that the QQQ, which was 11% off its all-time closing high at the close on Monday, March 8th, is now back to within 41 basis points of that all-time high. So that's in play today. You can see this in the chart in my blog where I've drawn a line representing that all-time high, and you can see how close we are at yesterday's close. Facebook is a great example of the kind of bounce back that we've seen in tech. It bottomed at 254.69 on Thursday, February 25th, since which it's bounced 23%, closing yesterday 7 cents, its all-time high, from Wednesday at 313.02. You can see the chart in the tweet by Grayson Rose that's included in my blog. Now, the problem here, of course, as mentioned on Tuesday morning, is valuation. Facebook is now trading at a 30 times enterprise value to 2020 diluted EPS multiple with a market cap of $905 billion. So there's a lot of, there's a lot of good news priced into these megatech, kind of safe feeling, safe haven sort of stocks that everybody's piling into. And I just don't see a lot of upside from a rational valuation perspective, but that doesn't mean they can't go higher just based off of pure emotion. Okay, section 2, the case for gold now. Okay, so this is the heart of this morning's morning blog. So there's a nice tweet from Macro Charts showing a huge outflows in the two main gold ETFs, the GLD and the IAU. This is the second biggest outflows in the history of the ETF. So a lot of investors selling gold. And what happens is sometimes you get a capitulation where everybody that wants to sell has sold. There's nobody left to sell. There's only buyers. Market finds a bottom. And that seems to be what's happening as price seems to have firmed up in the last week or so. So you can see in this tweet from Yuri Matzo that 1,700 is an important level, and we're holding above that. And he thinks as long as that holds, we can go higher. Michael Kahn points out that gold seems to have formed a double bottom. Now, Brian G is concerned about gold running up against its declining 50-day moving average, which is a valid concern. So that's price. Now, moving on to Mark Ungewitter had an interesting tweet showing the performance of gold relative to the S&P. And over the last 10 years, the S&P has almost always been outperforming gold, with the exception of a brief period in 2020 and in 2011. So the question that this tweet raises is, why invest in gold over stocks? Why not put your money in stocks? Okay, so now we get to the heart of the point of this morning's note. So if you look at these two tweets from Holger, I don't know how to pronounce his last name, Shapitz, you can see the balance sheets for the Federal Reserve and the ECB. So the Fed's balance sheet is now 7.7 trillion as of Wednesday, and the ECB's is 7.5 trillion euros. And you can see that about half of this has come since the coronavirus pandemic. So they're just flooding the financial markets with newly created money. And what this is doing is it's driving up asset prices, as the economist Daniel Lacalle points out. And the problem is that it's also now slipping into commodity prices and affecting interest rates, and therefore affecting the real economy. And when you start to see inflation, that's gold's sweet spot. So the technical picture is starting to look better. There's still reasons to doubt gold relative to stocks, but fundamentally, in my opinion, stocks are in a bubble while gold represents real value with tremendous fundamentals taking place and going forward for the foreseeable future. So, yeah, you can basically read what I've written here. That pretty much sums it up. So, I say to sum up, while the technicals for gold are starting to look better, a pure technical approach would have to prefer stocks over gold presently. However, if you take a look at the fundamentals, I would argue that the reverse is actually the case, with gold being the far superior investment for the moment. See you guys next week. Have a great weekend.